You got to have some kind of a percentage, some kind of a guideline that says, this is how much I'm going to spend. Otherwise, you'll spend it all. And a saver will save it all. And a giver will give it all. And it all is a mistake. You should always be doing some of all three. Always be a giver. Always be a saver investor. Always be enjoying your money.
No matter how much you make, there's a clear path to building wealth for every income level. Different incomes need different money management strategies. Like Dave Ramsey says, those who don't manage their money will always work for those who do. That's why today, we're diving into his tips on how to handle your money right when you get your paycheck. We'll be covering three main brackets: $15,000 per year, $50,000 per year, and above $100,000. So, no matter what category you fall under, there's still going to be clear steps for you to follow. As an important bonus, in the end of this video, we'll also be sharing tips on how to increase your income further, as well as what you need in your net worth to maintain a comfortable lifestyle once you stop earning. This may sound like a surprise to many, but according to a recent report from the Brookings Institution, nearly 50% of American workers between the ages of 18 and 64 work in low-wage jobs. And with the federal minimum wage sitting at around $7.25 an hour, a full-time employee will likely earn $15,000 annually. But hey, it's nothing to be ashamed of. You can still piece together things and make it work. But make sure you follow our tips to the letter, because out of all of the income levels we'll be discussing today, this is the level where your finances matter the most. Dave Ramsey once said that a good salary is one you can live on comfortably and provide basic needs like food, utilities, housing, transportation, and clothes without going into debt. And given how most people in this category are living from paycheck to paycheck, this is a sad fate for those who can't find a way to lock it in.
You're probably like most people, including me, when I first started this, in that by not having really good organization with my money and every detail laid out, the chaos eats these dollars for breakfast.
And how do we prevent this? When you're at this level, every single dollar has to count. You'd need to be able to save a minimum of 10% of your gross income towards your other goals. But before you gnash your teeth because of the apparent difficulty, remember what we told you earlier. A minimum wage can still work for you. How, you may ask? Well, we're getting to the good part. Here are three major milestones that you need to clinch. First off, it's crucial to avoid any consumer debt or buy now, pay later arrangements.
Our data says that the shortest direction, the shortest distance between you and wealth is having no debt.
Consumer debt can be a heavy burden regardless of income level, but it's especially detrimental at a salary of $15,000. Think about it this way. The average take-home pay of someone earning minimum wage is about $1,250 every month, and that amount needs to cover rent, feeding, transportation, utilities. Given how much you need to save and make investments to beat the rat race, how are you going to survive if you're still having consumer debt with large interest rates? It's going to compound your financial problems. So you see, that's why financial experts like Dave Ramsey believe the shortest distance between you and wealth is a life without debt. However, if you're already living with it, here are some lingering questions from Dave Ramsey.
Think about your budget right now. Think about your income. What if you had no car payment, no credit card payments, no student loan payment, no medical bills outstanding? What if you had no debt?
Your life would be pretty good, right? If you can save around 7.5% to 10% of your gross income every month and put it towards your debt, you'll be able to bring this reality to life soon enough. And while you're doing so, the next milestone you need to clinch is setting up a healthy financial foundation. By this, we mean you have emergency funds set up, and you're investing in things like dividends or stocks. We'd also advise you to contribute to a Roth IRA so that your earnings will grow tax-free. Now, some of you might find that saving 10% of your gross income is actually quite difficult, given that you earn $15,000 annually. If this is the case, stay put because the third milestone is how you can actually make even more money. If you make $15,000 per year, that's the equivalent of about $7.50 per hour, given that there are about 2,000 hours in a work year. So, finding a side hustle that pays at least $7.50 per hour, or ideally more, can make your time more valuable and potentially increase your overall income. And no, it's really not that difficult. People around you have problems worth solving, and they'll pay you for your time. For instance, if you're a good cook or baker, you can start a small catering or baking business from home. Many people appreciate homemade meals or treats for special occasions or even just for convenience. You can offer your services for events like birthday parties, office gatherings, or even weekly meal deliveries. By sharing your culinary skills with others, you can turn your passion for cooking or baking into a profitable side hustle. Even if you don't feel urged to set up a new skill or a side hustle, you can invest in yourself by pursuing extra credentials to boost your CV, giving you more leverage to get a better job or have a higher salary in another field. But in any case, the biggest thing you can do in the $15,000 income bracket is to ensure your interest rate debts are paid off. You can even use Dave Ramsey's snowball method. So with all of that out of the way, let's go into the second income bracket of $50,000. But while there are 3 strategies to effectively manage your income here, they're not exactly exclusive to people in this category. They just fit the $50,000 bracket the most. Nevertheless, the first is budgeting and tracking your expenses. Basically, what you want to do here is establish a habit of monitoring your income and expenses, plus understanding where all your money is going. This becomes even more critical if you have a family, because you'll have more people in your household to keep track of, therefore increasing your all-around expenses. But knowing what you're spending is just one part. The other is trimming it. Once you know how much you're spending on everything, you have to cut back on things that you either need nor generate value for. One trick that we've learned is that delaying pleasure curbs most impulse expenditures. And how it works is that once you see something you really want, hold off for about 24 hours. If you still want it after that, then go ahead and buy it. This way, you can avoid overspending on things that you might not really need. Another way to cut back on a certain category is to set yourself a firm budget. Dave Ramsey once said that a budget is telling your money where to go instead of wondering where it went. Believe it or not, strict budgeting, especially physically, can alter your financial psychology for the better. For example, say you allocate $200 a month for shopping expenses. Physically place that amount in an envelope. By doing so, you establish a clear spending limit for that category. Each time you make a purchase, you witness the money leaving the envelope, which can have a significant psychological impact, making you more mindful of your spending habits. The second strategy at this income level is to begin tracking your net worth, your savings, and your investment rates. Just like you need to monitor your diet or exercise routine to have good health, so does tracking your financial metrics improve your financial health. So, here's an interesting table of the median net worth in America by age. As you can see, the median net worth for people at the age of about 30 is $34,691, while for those at 40, it is $126,881. But where are we going with this? This is a cry for all of us to have a goal: double the median net worth. According to the retirement plan provider Fidelity Investments, the rule of thumb is to have saved up at least 10 times your income before retiring at the age of 67. To address this, take a look at the target retirement savings by age. So, if you make $50,000 annually, that means by the time you're 30, you should have $50,000 saved in your retirement as well as your taxable brokerage accounts combined. But it only goes up from there. By 40, you're expected to have north of $150,000, and by 50, $300,000. This really emphasizes the fact that if you want to retire comfortably, you need to have way more than what the median gets in America. Probably best if it's double. And this really segues nicely to the third strategy for people in this income bracket: targeting a savings rate that you'll have ready for a comfortable retirement. Now, depending on your age and current savings, your optimal savings rate will vary. For instance, If you're consistently saved 10% of your gross income every year since the age of 21, you're probably in a strong financial position. However, if you're 40 years old and haven't saved anything for retirement, you'll need to aim for a much higher savings rate than someone who started saving at 21. Let's consider someone earning $50,000 a year in 3 hypothetical scenarios based on their current savings. Remember how Fidelity suggests that by the time you're 67, you should have 10 times your salary saved? Well, this would amount to $500,000. If you're 30 years old and have $0 saved, you would need to start saving and investing around 5.8% of your income each year to reach $500,000 by age 67. At age 40, the required savings rate increases to approximately 13.6%, or around $6,800 per year. And if you wait until age 50 with no savings, you would need to save around 34.8% of your gross income, which would be around $17,400 per year in order to retire with $500,000. As you can see, starting to save at a younger age allows you to achieve your financial goals with a lower savings rate. However, as you get older, catching up becomes more challenging. That's why it's crucial to start saving early and remain consistent every year. If you're able to save 10%, 15%, or even upwards of 20% of your income, you'll be in a strong financial position. Alright, we made it to the highest income bracket of today's video, $100,000 and above. At this level, you're likely comfortable in most cities with regard to the cost of living. Your expenses are covered, and you're probably not living paycheck to paycheck. But here's the thing, a salary of $100,000 is in the big leagues, and it comes with its own challenges. Because you can afford to be really comfortable, you are instantly susceptible to excess gratification and compulsive spending. And if you don't nip it in the bud, you'll lose it all. So that's why the first thing you need to do is keep a close eye on your lifestyle. While it's tempting to upgrade your lifestyle with nicer things, like a car or a house, it's important to live within your means. Why? Because overspending not only hinders wealth accumulation, but also adds unnecessary stress. So if you want to make a big purchase, like a new car or a house, only do so as long as it fits within your budget. One of the ways Dave Ramsey advises people to spend their money is the 50-30-20 rule. This rule offers a structured approach to budgeting. It suggests allocating 50% of your income to necessities like rent and groceries, 30% to discretionary spending like entertainment or dining out, and the remaining 20% towards financial goals such as savings and debt repayment. This method provides a clear framework for managing expenses, ensuring that essential needs are met while also allowing for some flexibility in discretionary spending. By adhering to this rule, you can prioritize both short-term enjoyment and long-term financial stability, fostering a balanced approach to managing your money. At the $100,000 salary level, the second strategy is to strive for financial independence. With a robust income and a consistent savings rate, early retirement becomes a viable option. But it's crucial to identify the necessary steps to reach this milestone, such as bolstering savings, making prudent investment decisions, and trimming unnecessary expenses. By actively pursuing financial independence, individuals can chart a course towards early retirement and enjoy increased freedom and flexibility in their lives. A good way to get an accurate picture of how much you need to retire is by plugging in your income, savings rate, and portfolio value on networthify.com. For example, if you have a portfolio value of $200,000, you make $100,000 annually, and you save 20% while maintaining a 7% annual return on investment with a withdrawal rate of 4%, you can retire in 22.9 years. If you saved 30%, you could retire in 18.4 years. And if you saved 40%, you could do so in 14.6 years. So you see, it all boils down to how much you're willing to save. The more you do, the faster you'll be able to retire and live more comfortably. But the third strategy at this income level involves focusing on maximizing investment returns across all asset classes. Now, with higher incomes like $150K to $300K, you can consider riskier investments for even quicker growth. But make sure you acknowledge the higher risks behind them. But hey, if you're willing to do so, Try to allocate 5% to 10% of your portfolio to higher risk investments for potentially higher returns. This could include real estate syndicates, individual stocks that you have confidence in, or other good ventures. However, what you want to avoid is gambling-like behavior. If you're not sure of the company's credentials or whether they have the capacity to continue an upsurge, don't indulge. Something as simple as bad management or a bad review can cripple an entire conglomerate. Also, if an investment opportunity looks too good to be true, then it most likely is. Finally, make sure you have adequate knowledge of the industry you're banking your portfolio on. For example, if you have good knowledge of the pharmaceutical industry, don't bank on the banking industry, no pun intended. Make no mistake, investing within your level of competence and understanding is crucial for several reasons. Firstly, it will reduce the risk of making uninformed decisions based on speculation or hype, which can lead to significant financial losses. And secondly, investing in familiar industries or asset classes allows you to leverage their expertise and knowledge, increasing your chances of success.